Hello and welcome everyone. This is the Ethereum Engineering Group Meetup. I'm Peter Robinson and today I'm going to talk about applications of blockchain for business. So I guess I should introduce myself. I work at Consensus, have done for a bit over 3 years. I'm a researcher working on cross-chain transactions and cross-blockchain technologies. And also I'm looking at some work related to the Filecoin project. Work with, so Sandra's got her video on, so Sandra's part of the team as well, and David as well. And I work indirectly with Joanne and a whole heap of the other people on the call. And there's Raghavendra's got his video on too, so we're all good. All right, let's share my screen, share my slides. Okay, so everyone should now be able to see my slides. Can you see my slides? Thumbs up, thumbs down. Yep, we've got some. All right, brilliant. Okay, and so if you want a copy of the slides, just go to the Meetup page and look for the comments. I did one release of the slides and then a couple of hours later did a update. So yeah, certainly grab the updated slides. I try and take you from knowing nothing about blockchain to knowing a fair bit today. So we're going to go through the background material and then we're going to hit the applications. So starting off, message digests and message digests. So you've got a variable amount of data that goes into the algorithm. You use this algorithm to essentially create a fingerprint of the information. And so this is used to essentially be able to relate information. So if you've got that message digest, then you've got essentially the fingerprint of the information. So if someone changes that data just even a little bit, just by 1 bit, you'll end up with a different digest value. The next concept is about digital signatures. So you have a variable length piece of data go in and you get that digest, and then you've got a signing algorithm and you combine that digest with a private key and then you get a signature. So essentially you're signing that data. And then anyone with your public key can verify that data. And so what they're doing is they're verifying that you signed it. So you keep your private key to yourself, you give your public key to everyone who you want to be able to verify your information. And so it's a way of you proving that, or testing to some fact. So signing some data. And so blockchain, so you've got transactions. And so a transaction might be something like, I want to send some money to you. And so batches of transactions are combined into blocks. And the blocks are linked together in order, so in chronological order, to form a chain. And so if you want to update some information in the chain, you've got to do it to the end. So you can only do put new transactions into the last block at the end of the chain. You can't modify a transaction in the middle. And the transactions are included into the system using message digests. So if someone changed the transaction even slightly, then the digest would be wrong. And then all those transactions combine up into a single message digest, and then that links through into the blockchain. And so the links between the blocks are message digests as well. So if you change 1 bit in one transaction, then the chain the whole way along would change. And so people would be able to notice that. So you can't change anything in the middle. And so you can think of blockchain as an append-only ledger. So you essentially want to add information in a non-destructive way to track changes over time. And so you could imagine you might have a land registry, so a ledger of who owns a piece of land. And you might have one entry on when it was first bought, and then maybe they sell the property, and then that person sells the property, and then maybe right at the bottom, you've got the current owner. So you're not deleting the old information, you're just adding new entries into that ledger, into that book. And so originally ledgers were pieces of paper, so books. But then say in the 1950s, 60s and 70s, we had computerization happen, and you'd go from having ledgers being books to being recorded in databases on a mainframe computer. So blockchain is decentralized. And so you have multiple copies of that database, of that ledger of information distributed across a set of computers. And so the idea is that this decentralization leads to resilience. So if one of those computers blows up, dies, has the power go off, one of the network connections stops, then the overall system is still okay because you've got the database of information shared between those computers. All of them have a copy of it. And so you've got a user, say Alice there, and she signs a transaction with her private key. And so her account number is related to her public key. So anyone who's got her account number could verify a transaction that Alice signs. And then the signed transactions are spread across the network. They're gossiped across the network to mining nodes. And mining nodes are the nodes that create the new blocks. And then when a miner creates a set of transactions as a block, it then gossips that block to all the other nodes in the network. So there are multiple mining nodes. Otherwise, if there wasn't, then you'd have a centralization point. And so the mining nodes come to agreement on what the next block of transactions will be by a process called consensus. And different blockchains have different methodologies for doing consensus. So proof of work, or POW, is a methodology where you've got a cryptographic puzzle problem, and solving that cryptographic puzzle problem first means that you get the right to generate the next block. And so Bitcoin and Ethereum mainnet use that. And so, for instance, if you look at that photograph there of that factory of computers, all those computers are doing is trying to solve that cryptographic puzzle problem first. And so that then the company that operates that factory can then create the next block. Proof of stake is a way of validators staking some money to create a block and then using some sort of random selection algorithm to choose who gets to create the next block. And the next version of Ethereum, Ethereum 2, will use proof of stake. Proof of authority is an algorithmic way of choosing the next block. And so that's used with Consortium Blockchains. So when you think of public blockchains, you've got Bitcoin and Ethereum, but then you've also got hundreds of others. So Filecoin, Bitcoin Cash, Litecoin, Cardano. And then in the consortium space, you've got many platforms as well. So you've got Consensus's Quorum, you've got Hyperledger Besu, Hyperledger Fabric, Corda, and many more. And in addition, you've got to just the basic public chains, you've also got what's called blockchain level 2 scaling solutions. And so to address say, congestion on networks, and to allow you to do public transactions that scale the Bitcoin and Ethereum network, there are multiple systems for allowing you to run extra transactions. And these transactions often happen quicker and cost far less. And so you've also got these scaling solutions as well. So when you try and compare public versus consortium, so the consensus algorithm is normally you've got proof, or you'll have proof of work or proof of stake if it's public, where proof of authority is what you'll use in a consortium chain. So one of the algorithms such as, say, IBFT or IBFT2. So for centralization, so normally public blockchains are completely decentralized. Saying that, if you only had one node doing the mining, then it would be, you'd have a centralization point. So public blockchains have the opportunity to be decentralized, but it really comes down to the particular blockchain as to whether it really is. Consortium chains, if you've got, say, half a dozen organizations that are part of a consortium and each of them participate in the blockchain, it is decentralized, but purists would say, well, you don't have 1,000 parties. It's, you know, only a really quite a restricted number of people or organizations on that chain. So it's only partially decentralized. As far as participants, so public blockchains, invariably, everyone is pseudo-anonymous. So I think back, say, 10 years ago, people would have said you were anonymous if you were on a public blockchain such as Bitcoin. But I think there's been a realization that, in fact, it's only pseudo-anonymous. At the end of the day, say if you're a drug dealer or a arms trafficker and you're hoping to use Bitcoin as a way of, you know, anonymously getting cash, government agencies like, say, the FBI over in the US or the federal police in Australia, they will be able to hunt you down and associate IP addresses with Bitcoin addresses and Ethereum addresses, and they'll work out who you are. So it's only pseudo-anonymous. If you want to put enough effort in, you can work out who people are. In consortiums, everyone's known. And so invariably, you know all the participants. And though it is all known, you could have a situation where all the people who can write to the blockchain and make updates are known, but you're allowing anyone to read it. And so, for instance, maybe the system would be where you're wanting to show track and trace for a supply chain, and you want to show where goods are in that, and maybe you want to show ethical production. So you let anyone in the world view the information on the chain, but only set people can write to it. So with a blockchain, it's a computer program, and you've got adversarial people who don't necessarily trust each other on the chain. And some people who are outright hate each other. And so you need to have a way of enforcing good behavior and finding bad behavior. So on public chains, you have carefully designed cryptoeconomic protocols. And so what that really means is that if you do something bad, the system automatically determines that you're not behaving well, and it'll fine you and it'll incentivize good behavior. So an example would be you want to generate blocks quickly. And so you give a block reward to whoever creates the next block. And so hence everyone is incentivized to be trying to create blocks as quickly as possible. In consortium chains, generally it's external enforcement. It's all around courts of law. So if someone does something that's bad, then you will aim to enforce do an enforceable action in a court of law. Obviously, the software is still designed so that to try and block bad behavior, but there are obviously things that could be done. Access control, so who can make changes. It's relatively limited in public chains. So if you've got some sort of programmable logic in a blockchain, it might be quite limited. Where in consortium chains, you can lock it down. You can limit who can do what and what they can do. So generally you can't do private transactions or confidential transactions on public chains, whereas you generally can on consortium chains. And however, there is a protocol called the baseline protocol, which allows you to coordinate private state and allow you to essentially do private transactions with public blockchains. And before I go too much further, I need to explain a concept, which is zero-knowledge proofs. So imagine you've got Alice and Bob, and Alice says, I've got a blue ball and a red ball. And Bob's there and he says, well, I'm colorblind. I can't see, you know, they look the same to me. And so he says, all right, and he takes the balls, he puts them behind his back and he mixes the balls up. And then he presents the balls to Alice. If Alice can correctly guess which ball is which, then it's 1 in 2, so it's a 50-50. But if Bob puts the balls behind his back and mix them up again and represents them, it's 1 in 2 again. But if you combine those two challenge responses, it's actually 1 in 4 that she'll guess the right one, or 75% likely that she's actually telling the truth. And so you could continually repeat this challenge response, and then you would end up being able to, you know, Bob would have reasonable confidence that Alice was telling the truth, that these balls are in fact different. So the zero-knowledge proofs can be made to be non-interactive. So that would mean that Alice could just provide a proof to Bob about some sort of information without having to do some sort of challenge response. And so the zero-knowledge proof concept can be used to allow transactions to be executed off-chain and with a proof to be posted on-chain to prove that the transactions existed and have been executed. And so they allow things like private transactions and private state to be used with public blockchains. And so that baseline protocol I was talking about uses this sort of concept. So Bitcoin and Ethereum. So Bitcoin, the original white paper was done in 2008, and then the network was launched in 2009. And it was launched by a mysterious figure called Satoshi Nakamoto, who doesn't really exist. They're not a real person. But there's been lots of conjecture. I encourage you to do web searches on this and have a read, because it's a great story. And so Hal Finney, who was the top right photo, he had a neighbor around the corner whose name was Dorian Prentice Satoshi Nakamoto, who's the elderly man there. And so he has the form for potentially being Nakamoto, but maybe he actually worked in combination with Nick Szabo, who's the next photo down on the right, and also potentially Craig Wright. So Craig Wright goes around suing people who say he isn't Satoshi Nakamoto, and he is really good at suing people. However, in a recent court case when he needed to really produce some private keys to show that he could actually spend the $10 billion that he has in Bitcoin, supposedly, he couldn't access the money. So yeah, there's something going on there. Again, well worth a read if you want an interesting story. So Bitcoin, it only allows you to do value transfer. That's all you can do. So you can send money from one person to another. And it's got a 10-minute block period. And typically for confirmations, people wait 6 blocks. So that'd be 1 hour to be sure that a value transfer has really gone through. And that 1 hour, it's probabilistic. So it's going to be something like 1 in a million chance that it won't go through and that things could be reorganized. So if the transfer was for $1 million, you might want to wait 2 hours. Ethereum has a far more diverse group of people who are deemed the founders. And so Vitalik, who is the photo in the middle towards the top. He's the person who conceptualized the technology. And then he worked with a group of other people, all these other people, to come up with it. And some of these people are finance people, some of them are more business people, and some of them are software developers and software researchers. And so The Infinite Machine is actually a book that's come out relatively recently, which again helps you work through the story of Ethereum in the early days. So Ethereum lets you do value transfer like Bitcoin, but it also lets you do smart contracts. So smart contracts are computer programs that run on the blockchain. They're just simple things, but it's programmable logic or programmable business logic. So it allows you to have great flexibility. So you normally want to wait 15 seconds. Or rather, the 15 seconds is the block period, and you normally want to wait 10 of those blocks to be certain that a transaction is locked in. So that's about 2.5 minutes. So it's much better than Bitcoin's 1 hour, but it's still 2.5 minutes to be certain. And again, it's probabilistic. So it really depends on what the transaction is. So if the transaction's just, I want to buy a cup of coffee for, $3, $5 or something, then maybe you would only wait 1 block confirmation. Whereas if it's, $1 million, then you might want to wait 30 or 40 or 100 block confirmations. Depends on the use case. Ethereum 2 is coming. And so Ethereum 1 has been around since 2015, and Ethereum 2 is due to go live later this year. And so the idea of Ethereum 2 is it's going to give you massive scaling over what's available at the moment. So maybe 100 times performance improvement. And so I said that there were these smart contracts, this programmable logic. And so this is an example one that I've just put together, very simple, where you launch the contract and it sets up who the owner is, it sets up an initial value, you can get the value or you can set the value. So that's pretty straightforward contract, very small, but you can see what I'm saying, that you could write arbitrarily complex code and that can do business logic. And so the reason why a lot of people have got involved with Ethereum is that the vast majority of developers who are out there who know blockchain know Ethereum. So they know how to code on Ethereum. It's also open source, vendor neutral code base. So that means that all of the implementations are open source and that there are multiple implementations. So if there's a bug in one version or one variant of the software, then the other variants are all good. There's public versions and there's also private consortium versions. So you can run the software in a variety of scenarios. Are there any questions at this point?
Sorry, Peter. Nigel speaking. Can you hear me?
Yes, I can.
Yeah, I just had a quick question on the proof of work. And maybe I'm better off describing how I understand it, and you tell me if I'm right. With proof of work, a mathematical challenge is created, and I understand it's sent to the miners, and then whichever miner solves the problem gets the right to create the next block. But where does the actual mathematical problem come from? I still in my mind have this belief there's a central computer creating the mathematical problems that need to be solved. And so I'm trying to understand where the decentralization in that process is. Does that make sense?
Yeah, your question makes sense. Okay, so the puzzle problem thing, that's an algorithm. So like that message digest algorithm, it's just an algorithm. So it's a set of instructions or a process. So then there's the data. Where does the data come from that feeds that algorithm? And so each miner gets a set of transactions, and the different miners will have a different set of transactions. And in fact, they may choose different transactions based on their own policies. So some miners might say, choose the first transaction they see. Other miners might choose the transactions that are going to pay the most. And so, and you've got to think that you're on a widely dispersed network. And so you might have like a miner who's in Europe, they might see some transactions that are in Europe and they might not have made it over to, say, USA or China or Australia yet. So different miners will have different sets of transactions. And in particular, one thing that they'll each have that's different is, one of the things that goes into it all is, who are you going to pay? And obviously they're going to pay themselves. So each of them have a different piece of information saying who to pay. And so that is the information that feeds in. So because they've all got their own sets of transactions, they're all going to pay themselves, then that goes through the algorithm, and it's really comes down to looking for processing that information and then looking for a number which is less than the current difficulty. And so the difficulty number is set so that on average, you'll have the block period will equal what your target is. So if you're in Bitcoin, then the target difficulty will be set so that you have 10 minutes, or it's likely to take 10 minutes to solve the cryptographic puzzle problem, given the number of people who are looking to try and solve it. Does that make...
That difficulty you're talking about, that's the hash rate, yeah?
It's related to the hash rate, but it isn't the hash rate itself. So the hash rate is the number of, is the amount of computing power going into trying to solve the problem. So the number of hashes, whereas the difficulty is related to that. So if there was, say, twice as much hashing power and you wanted to have the same block period, then your difficulty would double as well.
Yes, there's a relationship there then. Okay, yeah.
Yeah.
Thank you.
Okay, let's talk altcoins. So altcoin means alternative to Bitcoin. So all of these altcoins claim to give improvements upon Bitcoin's technology. A lot of them were just scams. You know, they're ideas that didn't really change too much, and they just aimed to make the creators of them rich. And so in 2011, there was Litecoin, and so it offered faster block time. So rather than 10 minutes, 2.5 minutes. There was Monero, and it aimed to give you anonymous value transactions. And unfortunately, some attackers have determined some vulnerabilities in the last year or two, but they had a 2-minute block period. Ethereum came along and it offered those smart contracts, so the programmable logic on the chain. And so it's down to about 15-second block period. Zcash, so it's pronounced with an American Z, so Zcash. It does anonymous value transactions like Monero, but by a completely different mechanism. And then there was Ethereum Classic. So Ethereum forked. So there were 2 versions of the blockchain ended up going, and 2 groups of people ended up going in different directions for the actual blockchain. And so Ethereum Classic, though, it has the problem that the amount of proof of work mining power, so the hash rate, isn't high enough to be secure. And so people can attack the blockchain and reorganize the blockchain. And there are hundreds and hundreds more altcoin blockchains. So ERC20. So an ERC20 is a smart contract. So it's one of those Ethereum contracts. So it's just got some programmable logic. And so you've got some fixed set of functions that are available. And so the idea is you can issue a coin on top of Ethereum. And so it allows you to issue your own cryptocurrency without actually running your own blockchain. And so you can think of an ERC20 contract as being a registry of who owns what. So for each address, you have how much of the coin or ERC20 coin that person owns. And so the ERC20 contract has a set of functions, as I said. And so one of them is total supply, and that tells you how many coins are available for that whole ERC20. Balance of, so you pass in an account number and it'll tell you what the balance of that account is. Transfer, so transfer from my account to another account. Transfer from is where you say you have a contract which is set up, and it then says, can you please transfer from this account to that account? And so the idea is that you're essentially approving an allowance of coins to be transferred. So you're allowing a contract to operate on your behalf. And so approve is used to authorize another account to operate on your behalf. An allowance is the number of coins that entity can still use. So have a look at the link on the ERC20 standard to get a better feel for all of that. And so if you want to create or use an ERC20 token, all you need is the address of the contract because the API, the functions are standard. There are 287,000 current contracts, and I encourage you to go to that link because the number of ERC20s that are deployed is going up daily. And it's funny, I gave this talk back in about January this year, and at that point there were only 240,000 contracts. So it is pretty amazing. So ERC20 tokens are fungible tokens. So fungible means that they're all the same. So you can look at the diagram here, and across the top there, each of them are identical. ERC 721 is a non-fungible token system, and it means that each of the tokens, each of these coins, as it were, are different. And so you can think of it from a fiat currency perspective, say Australian dollars, all $20 notes are the same. So they're fungible. Whereas maybe there is some sort of, I don't know, card or, game card or something. And so each of those things is different. And so non-fungible tokens have been used for a variety of things. And one of them was actually CryptoKitties. So this is yet another, or this is an example of how you have each of these kitten things was unique. And so people were trading them and spending heaps of money on CryptoKitties. It might sound crazy, but at the end of the day, this, people made money out of this. And so, yeah, something to keep in mind, that tradable tokens. Another thing, though, to think about with these ERC 721 tokens is they could be used for representing real-world objects that are all unique, such as a diamond or something like that. Stablecoins. So a stablecoin is essentially an ERC20 token or cryptocurrency that is pegged to the value of an asset which is stable or relatively stable. And so it allows you to make payments in cryptocurrency, but without the price fluctuation risk that you might have from, say, Ethereum or Bitcoin. And so this has been used, say, in Venezuela, where they had a hyperinflationary environment to allow people to get their money out of the country. Also in Greece, where their banks suddenly stopped people from doing withdrawals, people bought stable coins, so bought US dollar stable coins so that they could get their money out. People also use stable coins for hedging. So essentially, if you're a cryptocurrency trader and you want to put your money into US dollars temporarily, you can use a stable coin. And so you've got fiat-backed stablecoins, but you could also have other ones, say, backed by gold or something like that. And so there are, these examples across here: Tether, USD, True USD, DAI, and others. And so these traders, or crypto stablecoins, how they seem to make money is in transaction fees. And so Tether charges 0.1% transaction fee. And as you'll see in a few more slides, they do a trading volume of 34 billion per day. That would mean that they're still making $34 million a day from crypto exchange. So yeah. Here's the slide. Yeah. So Tether, as I said, it's a US dollar equivalent cryptocurrency. It's a stable coin. So the idea is that it does things to keep the currency at approximately $1. And the market cap is 13 billion, but the trading volume is $33 billion. And as I said, they do a 0.1% fee. So that means they're making $33 million a day from trading. However, there have been concerns over Tether. Some people feel that it's just operated by a single company, so that's not very decentralized. And the company had said that they were cash reserves or real world assets to cover their ether exposure. But then they haven't been able to produce anything when they always said they were going to do audits. So yeah. Another one that's out there is MakerDAO. And so it's a decentralized ERC20 stablecoin. And it's an exchange it's exchanged without any intervention, any middleman, any company, or any government. And it's not quite as stable, but it's still pretty good. Much lower trading volume though. And so, yeah, normal users can just buy and sell it. However, if you're a sophisticated investor, what you could do is you can help stabilize the coin and hence make money. So say if the DAI is trading at $1.04 and you put in $1 of ether into it, then you instantly have $1.04 of DAI. And hence you increase the supply of the DAI and then you reduce the price. However, say the DAI was trading at 96 cents, then you could destroy that DAI and then get $1 back in ether. And so, so you've suddenly made 4%. And this will reduce the supply of DAI and hence increase the price. So it self-stabilizes. And using another stablecoin sort of thing is the Icelandic government have decided to release a blockchain-based Icelandic krona to allow for cross-border payments without financial middlemen. And so the digital Icelandic krona is supposed to be going to be launched across the EU in an initial stage. Are there any questions at this point?
Hey, Peter, it's Gabor here. It's slightly off topic. Just wanted to ask your opinion on gas fees. Like a lot of the, when you talked about ERC20 and DAI, it popped into my mind that a lot of the DeFi services like Compound and Uniswap have recently, like the gas fees gone up really high. And do you think, is there any quick term solution to this, or it's just, it is what it is? And if it's off topic, just say it now, but we cannot discuss it now, that's fine.
Yeah, it is a very good topic to talk about. Why don't we take that one at the end, because it is because it does cover everything, and that is actually why I mentioned those layer 2 scaling solutions, because I think they've got to come into play more. I think people will be pushed to do them because, yeah, I think the $10 transaction fee at the moment is not really going to be a long-term thing.
Yeah, cool. Thank you.
No problem. Okay, ICOs, STOs, etc. So a security token is sometimes known as an asset-based token, and allows you to do fractional ownership of an asset. And typically you have it as an ERC20 token. And so maybe it could represent shares in a company, and it could provide liquidity to assets which historically have lacked access to trading opportunities. So you can think of high liquidity assets being, say, bonds or stocks, shares, whereas low liquidity assets could be, say, artwork or jewelry. And so if you can tokenize, say, a piece of jewelry and allow multiple people to own it and you to trade it on an ERC20, then you're essentially, like providing liquidity to it. And yeah, so that is what a security token is, or an asset-based token is. And so you could imagine, say, a group of people make a movie and the group owns the intellectual property rights, and you could issue a security token representing everyone's partial ownership. And so individuals can trade their partial ownership with others. Yeah. And so that would be a way of allowing trading of something which historically has been very difficult to trade. So ICOs, they're all about issuing utility tokens. And so you're giving users the right to a service which might not be available yet. And so you can think of that as a gift card. Security token offerings, they're all about issuing security tokens. And so they will like give partial ownership of assets. And so you can think of that as a share. And so ICOs and STOs, are offering tokens to the general public. And some of the ICOs historically have not complied with regulatory requirements. And some people have got into some really big trouble due to doing illegal offerings to the public. So yeah, you need to be awfully careful when doing an ICO or an STO. And so the historic process, so back in 2017, I think some people, they had a thought bubble, and then they set up an ERC20 token, they wrote a paper, put it, banged out a website, and then they, hoped people would give them money, and, they'd pump it. And so a lot of those thought bubble ideas, they were products that were really not ready for launch. And so using an ICO to launch a utility token, which really ends up being a security token. So if you're offering people partial ownership of your company, but calling an ICO, then you're going to end up in trouble. The other thing is there are a lot of scams that were launched as well. So yeah, so there's quite a few problems with ICOs historically. But not to say that all of them are scams. And so you hear about STOs as well, and as a way of raising capital. Okay, applications. So when we're going to go through a whole heap of applications, but the thing to think about is, we need to be reducing costs or doing things faster or doing things that just can't be done any other way. That's what you want to be looking out for. And part of it's going to be disintermediarization. So removing intermediaries, doing peer-to-peer sort of business, and offering transparency, providing visibility to partners and customer data that's just not currently there at the moment. Maybe removing the political centralization, so not having to just have one party running everything, or architectural decentralization, so removing single points of failure. So you're not having to worry about having some central server that blows up or some network connection that stops. And also you should be thinking about authenticity, integrity, and non-repudiation. So authenticity, leveraging the idea that you know who signed a transaction, you know who's got that private key. So they've signed for something. Integrity, knowing that people can't modify the history. And non-repudiation, making sure that you can't deny actions. And another really big theme of all these is you have multiple parties who want to own the data, who want to own the information, but they don't trust each other. And often in these situations, there's paper-based and spreadsheets and databases, and it's often a mishmash of systems as well. So look for that in the examples. So the number one use case, so the use case that started it all really was banks charging too much money to transfer money and taking too long. So at the moment, if you send money from Australia to Hong Kong or the UK or anywhere in the world, it's probably going to take you a week and cost $20, $30, maybe even $50. So cost a heap of money and take a very long time. Whereas in a decentralized financial system, you could connect to the blockchain and do an instant transfer. And historically, it's been for a very small amount of money. But as was pointed out just before, right at this instant, transaction fees on Ethereum are sitting at about $10. One extra thing, though, of course, is that you've got your fiat currency in a normal bank account and you need to get your Ether or Bitcoin or whatever. So invariably, you've got to use some sort of service, such as CoinJar, to take your, you do a BPay across to CoinJar, and then suddenly you've got some Ether. And so that, when you're first getting started, that can take some time to set up because they want to do good, know your customer. And even when you have done it, it might take, say, 24 hours for that transfer to go through. However, assuming that one thing to think about as well is that CoinJar will want to charge you some amount of money to do that transaction, maybe 1%. So it's still better than the normal banks where, in addition to that $20 or $50 fee, they might also give you a really bad comparison rate, so international transfer rate. So the next thing that's really big is DeFi, so decentralized finance. And so what it really comes down to is peer-to-peer lending. So it's often, there isn't good know your customer, but there might be know your transaction. And so you've got these stable coins like Maker and Tether, which are used for US dollar substitutes. And so one example of a DeFi application is compound finance. And so note that red box to the top right. So I just typed in the URL as it is there, thinking that I got it right, and I must have done one keystroke wrong. And Telstra, my ISP, actually intercepted the request, which was incredible. I've never seen that happen before, and essentially block it saying this is a malware site. And but when I copied that in directly from the slides and I got the right site, it was all good. So there are obviously attackers who would really like you to hand over your money to them. So anyway, compound. So the idea is that you've got one asset, say Ether or DAI, and you want to borrow some asset in a different currency. And so you put up your currency as collateral. So maybe you put up your 100 ETH as collateral, and then your supplied assets earn interest on a per block basis based on other people who need some Ether to loan. But then you've got this thing called the collateral factor. And so say if the concern is that the value of the coin might drop a bit, then the collateral factor might only be, say, 50% or 75%, and it means you can borrow up to that collateral factor. So you're earning interest on your deposits, and you can get some other coin directly without a transaction fee. And yeah, so you can, and it allows you to transact all sorts of different assets, including, for instance, wrapped Bitcoin. So you've got Bitcoin on the Bitcoin blockchain, and then you've got an ERC20, which gives you wrapped Bitcoin. So that's essentially Bitcoin that's locked on the Ethereum blockchain and can be used in a DeFi situation. There's also decentralized exchanges. And so you've got crypto exchanges where you pay money to do transactions, and they're run by centralized players, but you've also got decentralized exchanges where there are no middlemen. It's just a smart contract, and it allows peer-to-peer transfer of and trading of goods. And so the idea is to give you better liquidity and lower fees as well. And so there's a whole stack of decentralized exchanges in the DeFi space. And this is a diagram which I stole or borrowed from the Consensus's DeFi report. And so this is showing the number of entities that have got more than 100 transactions on DeFi platform. And the yellow ones are for users that deal with more than 2 exchanges, or 2 of them. And then red is when you're dealing with more than 3 and involved in more than 3 different types of platforms. And it also shows you the range of different platforms that are out there. Another DeFi application is syndicated finance. And so you can imagine you've got a syndicate who want to offer money to a large corporation, a large project, a sovereign government. But you know, the individual banks aren't prepared to fund it by themselves. And so the idea is they come together in a consortium, a syndicate, and they offer the money. And so doing this on the blockchain allows for automation of some of the steps in the process, and which reduces costs and also reduces time to settlement. And so I've got an example there that you can have a look at, but essentially using blockchain to reduce time and cost. There's also the JP Morgan coin. And so JP Morgan have released a currency, essentially, that allows you to exchange value. So this one's just on a Consortium blockchain. And so what it's allowing is you to transact money between accounts, between other banks. So you can essentially letting you to do interbank settlement far quicker than you otherwise would. The Australian Stock Exchange did a CHESS replacement. So CHESS is essentially the computer system to settle share transactions and work out who owns what shares. And so to use their term, it's a post-trade platform for the cash equity market. And so the idea of going from the old computerized system to the new system is to improve performance, resilience, and security, and add some functionality and be more standards compliant. And so it's all, it's going to allow the more parties to collaborate better and have more up-to-date information and be able to have a better audit trail of what's going on. One interesting aspect of this massive project is that it began in 2015. the go live date was going to be April 2021, but it's been pushed out due to COVID-19. So I'm not sure exactly when that's going to happen. And so the company that did the DLT solution for this is Digital Asset. Yeah, so I think it's quite enlightening to think if you want to have a massive system in place that involves many, many parties, it's not going to happen in 6 months or a year. It's going to be a multi-year project. Consensus has got a DeFi product as well, or set of DeFi products that all work together. So given I work for Consensus, I thought I should put that in and give them a bit of a boost. And so these are platforms. So say if you're thinking about wanting to set up your own payment platform, or issue a stable coin, or do a STO, or do some workflow management based on blockchain, having blockchain as the basis for it, then you could use Codify. And yeah. Yet another DeFi application, and this one's in Sydney in Australia, is esports. And so so have a look at Gods Unchained. It looks great. I haven't actually played it, but so they've got these digital cards that trading cards within the game that people pay for. And so the idea is that users actually want to have ownership of those in-game tokens. And so why this has come into particular highlight is that there was someone who was very high up in, I think it was World of Warcraft, and they won some championship, and they had a whole stack of prize money that was awarded to them. And anyway, they said some tweet or public statement essentially about democracy in Hong Kong. And so they were stripped of their prize money, they were removed from the leaderboard, and their whole account was deactivated. And so, which is pretty massive if you were really into that game. And so offering decentralized ownership where, even though the game is operated by Gods Unchained, you will still own those ERC 721 tokens, and you could trade them outside of the game if you wanted to. So now I'm going to move on to real estate. So before, I mentioned the idea of tokenizing illiquid assets such as houses. And so you can issue an ERC20 token representing the house and sell parts of the house. And so in particular, you could imagine if you had a communal living, so communes, or if you had timeshare apartments, this would be a really good way of making it nice and simple to trade your ownership of that asset. You can also do fractional investment. And so maybe there's an apartment and it's going to cost $800,000. But if you're buying it off the plan, you only have to put in $200,000. And then the idea is by the time it's built, it's going to be worth $1 million. So maybe you don't have 200,000. So maybe what you could do is offer fractional ownership of the apartment, of the investment in the apartment. And so you could sell $20,000 tokens with an initial deposit of $5, where essentially you need to then, you'll just be buying it at 5K. And so it would allow you to be able to trade your ownership. Also, the token holders, once the flat is built, they would then have the right to share in the rental return of the apartment. Another big area is land registries and cadastrals. So land registries are typically stored offline, and information is open to manipulation and fraud, especially in the third world, in developing nations. But in any country, it is open to manipulation if it's not public. And so if you store on the blockchain, then it's transparent who owns what land, and it's also transparent when changes are made. So you can see who made what change. And so if you do a web search, you'll find lots of cases of people who've essentially had their land taken from under them by essentially fraud. And so it mitigates significant problems that have plagued developing countries where people's land is stolen from them. Development applications and approvals is another big area. I've had multiple organisations present use cases, present proposals, and some that are in proof of concept stage. And I believe there's in Dubai, they've actually deployed their systems for development application and approval. So development applications invariably involve multiple agencies, and there's lots of different systems that are involved, and it's a bit of a mess. And so if you can use the blockchain, then you're going to provide transparency and improve efficiency. So supply chain, there are multiple areas of supply chain applications which are interesting. And so one of them is anti-counterfeiting and quality assurance. So if you're a supply chain or if you're a manufacturer, you're worried about counterfeit products, and you really don't have. I can see I've got a typo there. So producers, you don't have visibility into the supply chain. You don't know necessarily where your goods have gone, and consumers aren't completely sure of where the goods have come from. And so if a adulterated product, if a counterfeit product or falsely labeled product is sold, then you're risking you're having reputational risk. And also maybe, if you've got strict compliance saying that something's going to be organic, and then someone mixes in some non-organically grown produce, then you're risking your certification. And so blockchain can be used to overcome these fraud problems and quality assurance problems. So you can have proof of authenticity of your highly priced goods. So you can track the primary production through the transformation steps as well, and watch for quality. So say with beef, you could have someone taking the beef in a refrigerated container, and they might choose to save a bit of their petrol and electricity by disconnecting the refrigeration. So the goods themselves will not look any different, but their quality will have degraded, and so they won't last as long. They won't maybe not taste as good. And so if you have a temperature sensor in there, an IoT device, then you'll be able to measure the temperature as it goes, and then be able to put that onto the blockchain, and then have assurance that that meat hasn't had its quality degrade. And so there are multiple examples of this sort of anti-counterfeiting work going on. So there's Beef Ledger, which is a group in Brisbane working between universities, QUT, and others, the Food Agility CRC. You've got LVHM, who do Louis Vuitton and Christian Dior, and they've got their own provenance platform. We've got AgriDigital as well, and they do grain track and trace. Another related topic, but subtly different, is ethical sourcing. So has slave labor been used to gather the raw materials? Are they being sustainably mined or grown? And are the staff paid appropriately? And so, you've got, say, that picture on the bottom right there, where you've got someone who's made a garment for less than $1 that's going to be sold for $50. Or the people in the bottom left who are mining tin in Indonesia in really unsafe conditions. Yeah. And so, you know, you can use blockchain to help improve, verify the claims that brands make. And so there are a stack of different organizations tracking all sorts of different objects and things, from fibers to vaccines, diamonds, tuna, all sorts of stuff. And in fact, one example is tampons. And so what they have is they'll have a barcode, a QR code on the outside of the packet and a 10-digit lot number. And so you scan the QR code and you're taken to the web page to the right, and then you enter the lot number, and then it'll allow you to look at the journey that that cotton has gone on so that you can be sure that it's organic cotton that's being used, so that you can verify the claim that the manufacturer is making. And so Tampax are using a company called Ethereum to do that as the underlying platform. Logistics is one of those great examples where you've got lots of different organizations involved who don't trust each other, and there's, you know, all sorts of information going in all directions and people using all sorts of different systems. And so there's lots of paperwork involved. And in fact, that's a big part of the cost of freight is paperwork. And there's information asymmetry, so lack of visibility into, you know, what's going on. You know, why were containers redirected and moved around? So, you know, I've heard of examples where you've got a truck goes from the Port of Brisbane out west to a farmer to have stuff put into the container, and then it turns out the container that's been brought out isn't a food quality container. So then the truck has to turn around, go back to the Port of Brisbane and get the right container. So, you know, you can imagine that this lack of visibility, this lack of information allows these sorts of things to happen. And so because also you don't have the visibility, then you can't work out, well, who's responsible for this issue? And so who should be paying for it? So, yeah. So having a you know, single source of truth, the blockchain, would be good. And it really should help, you know, like making sure that you don't have these problems. And so you can have centralized systems. They could be possible. So you could have some sort of port authority system, though you have people, you know, the individual companies worry about competitiveness and confidentiality issues and just generally loss of control. And so if you had a blockchain, then, you know, you've got a decentralized encrypted open platform where you can do efficient, transparent and trustworthy flow of transactions. And so it solves a lot of these problems about, you know, individual companies wanting to own the data and being worried about who owns the data and what algorithm is going to be used to update the data. Yeah, and it helps to resolve disputes. And, you know, you know that even if you're a small player, if you're using a blockchain, then all the rules apply equally. And you can see the logic which is applying the rules, so that you can't have some big player coming up and unilaterally applying some business rule and changing everything on you. So there are a lot of ports that are getting involved in this sort of thing. And Comgo is actually a company which has a platform that helps to automate a lot of this. Supply chain financing is another big area. And so imagine that, you know, this is a supply chain and you've got, say, the manufacturer Mark, who's making mayonnaise, and they supply, say, retailers. And then they deal with, you know, some upstream providers, upstream companies. And so it's easier for, say, if Reginald, Reginald's Regional Produce, if they want to, say, get some financing, they can say, hey, we've got a signed invoice from manufacturer Mark, and we know that we're going to get paid in 120 days. And so, they'll probably be able to get invoice financing. Whereas if you're Farmer Fran there, then you're far less likely to be able to get any financing, because you provide the Reginald's Regional Produce, but you might not even know that your produce ends up in manufacturer Mark's goods. But if you were able to have that information transparent, just enough information to be transparent that then you could get your invoices financed. And so I've had two different organizations who've guesstimated that if you can solve this problem well, then you would free up $10 trillion worth of finance across the world. So, this is big stuff if you can solve these problems, and using blockchain could help you solve these problems. And if you're interested in supply chain in particular, there's been the Supply Chain on Blockchain conference that Sandra, David, and myself have run last year and this year. And the videos and slides are available at those links. And it talks about all sorts of aspects of supply chain on blockchain. Telecommunications. So call roaming, user authentication. So at the moment, if you go overseas, hop in well, not that you do it at the moment, but if you cast your minds back to a year ago, if you hopped in an aeroplane and you landed in the US or Singapore or London, Dubai, you might be staring at your phone waiting for it to connect for 5 minutes, maybe 10 or 15 minutes. And that's not uncommon for that roaming authorization request to take that long. There's also the requests use SS7 encryption, which has been brute forceable for a decade. And so, people could forge the messages as well, theoretically. And the current systems are really costly. So it's been proposed in that you have used blockchain as a more efficient information sharing platform between telecommunications providers, and that you use a combination of modern cryptography to provide the information, essentially. And the blockchain would hold a registry of the telco providers, so essentially their public keys. And this would allow telcos to quickly communicate securely and thus provision roaming services much quicker and more efficiently. So the link there at the bottom is the Enterprise Ethereum Alliance use cases for telecommunications, and they walk through this in graphic detail. Another use case that those people have walked through is call roaming reconciliation. And so there are many problems with existing mobile roaming reconciliation systems. So you've got this sensitive business data that you don't want to share with other companies, and you've got to be worried about spoofing and fraud, and there's huge volumes of data, so it's complicated. And so you could use blockchain between businesses or between telcos for the business logic. So you could have, say, a smart contract on an Ethereum, Consortium Ethereum chain that could have the business logic behind, given a type of call, how much should be paid given the user's type of service that they've got. And then you could do a layer 2 off-chain communications channel, payment channel, as a way of communicating information such as the call logs and invoice information. Yet another mechanism is peer-to-peer energy trading. And so you could imagine that you might be, say, have solar panels on your roof, and you might want to sell your energy in a peer-to-peer fashion between grid-connected parties. And so if you're doing peer-to-peer trading, then maybe you would get a better fee for your, say if you had excess electricity, you're going to get a better fee for your electricity than you would if you just had, if you just sold it back to the normal power generators. Also, the people should be able to buy the electricity from you probably for less than they pay the normal power generators. And so you use blockchain as automatic deal negotiation or auctioning of the excess power and also accounting. And so I know that in Western Australia, they're currently looking to trial a virtual power generator just using solar power from people's roofs. So rather than having to have another power generator, they're thinking about using that. Also, if you're, say, got a townhouse estate, so you've got your own electricity grid, mini electricity grid, then you can do this sort of thing. Generally, though, in Australia, you can't do this sort of peer-to-peer trading across the public electricity grid. And Power Ledger over in WA and Grid Plus are involved in this technology. Voting is yet another area. And so blockchain voting is an interesting idea. So everyone would register, and then you would be able to identify who's voted and be able to count their votes. And so you'd be able to ensure that you'd be able to see transparently who voted for what. And it would be unchangeable and it'd be publicly viewable. So obviously there's a problem with this for many types of voting. So there's usually, or quite often, you want to do secret ballots. And so if you're, say, electing government officials, especially in jurisdictions where you're worried that the government might have a crackdown, you would really not want to have your votes traced. Like a good example would be Belarus at the moment, where you've essentially got a dictator running the country. And so you can imagine if it was all going to be public who voted for who, then you really would have to be careful about voting against them. Whereas if you had a secret ballot, then you'd feel more confident. So the blockchain voting, you've really got to be thinking about what are the use cases that we're going to do. However, saying all of this, doing off-chain blockchain voting, but using a zero-knowledge proof to prove that you voted one way or the other, but not saying which way you voted, could possibly be another way of doing it. So yet another use case is decentralized autonomous organizations. And so the idea of DAOs is that they allow you to cooperate on rule encoding that, on the blockchain. So you have the business logic behind how you're going to make decisions on the blockchain. So you don't have to have some sort of centralized administration. And so so Maker and Compound, for their decision making, it's actually within the contract. So they're essentially a decentralized autonomous organization, each of them. And so it allows you to do decentralized governance. Healthcare. So you can do medical record sharing. And so you can share information and it's tamper resistant. So you don't have to worry about people, say, forging or modifying your records. Say for insurance, you'd be able to have, say, transparent algorithms. So you would know under what circumstances a policy was going to be paid out. And you might be able to do faster processing of claims as well. Medical research is another good one where you can easily, share the data that you've got. So you can have essentially a shared database of information, the blockchain, and it's going to be tamper resistant. So the research data can't be retrospectively altered. So, this is important because sometimes trials happen and then people modify the results later on. IoT. can be used to add security. And so this is some work that David Highland Wood, myself and some others have worked on, where the idea is to allow you to do authentication or do two-factor authentication for doing commands, say for instance, to a satellite. You know, so you wouldn't want someone to hack a communications link to a satellite and tell it to deorbit or something like that. So if you could do two-factor authentication, then that'd be good. CSIRO have looked at doing automated software updates as well, or rather authenticated software updates. And so they've got a paper on that about how you could use blockchain to do authenticated software updates for IoT devices, such as your engine management system in your car. Another good one is charities and transparency. So when you donate money to a charity, you often don't have much of an idea how the money's really spent. You know, are people paying for first-class airplane tickets to go from here to wherever the money's going to be used to make sure it's being used appropriately? Are you paying for lots of salaries and administration and not much actual, you know, work being done? So Tokens for Humanity, they provide transparency and also give you the opportunity to actually donate your cryptocurrency as well. So they allow charities to accept cryptocurrency as a donation form, but also provide radical transparency. A big one that people talked about way at the start of blockchain was banking the unbanked. So unbanked people are essentially people who don't have a bank account. So if you live somewhere and you don't have a bank account and someone gives you $100, then you have nowhere to really safely put that $100. So then when later on someone comes with a big stick and says, give me the money, you end up having to give them the money. And so it stops countries and people becoming wealthy or having the opportunity to have wealth because they don't have anywhere to put their money. So in the Philippines, they did have banks, but their banks were what's called rural banks, where they can't do even inter-island transfers. And remembering that the Philippines is a massive island country, so they had essentially problems with banking. And so Project I2I, which is one of the ones that I didn't work on, but other people at Consensus did, and I think they should be really proud. They've enabled, I think, 60 million people in the Philippines who previously didn't have normal banking services to do normal banking. And so this is massive for the Philippines because a lot of their economy is built on remittances. And so people sending money home. So if you were working in Manila, but you come from some village somewhere, this would give you the opportunity to send money home. And emergency decision making. So I've copied a lot of this text. It should actually be in inverted commas, but I didn't put it in inverted commas. So essentially the invention of nuclear weapons, faster decisions need to be made by fewer individuals to ensure you don't have high impacts of magnitude that could change the world's population overnight. I mean, yeah. So essentially that, I think you're supposed to have war games happening in that picture on the right-hand side. So the thought is that you could have blockchain as a way of making sure the right people are making the decisions and that enough people are. So you could imagine, you know, you've got the two keys turning and then you're launching your nuclear weapons. Well, this sort of would give you the multiple key situation, and maybe one of the key, you know, some of the keys have to be people who have actually made the decision, so that, say, if the two people in the bunker suddenly decide to turn the keys, then nothing will happen. So you've got to have a multi-party authentication. And the other thing to think about is using blockchain adds resilience. So even if you did have a nuclear bomb go off and it wipes out a part of the network, because you've got these this redundancy in it, this decentralization, then the whole system keeps on working. And you could think of during the September 11 attacks, there were some key servers and the backups. So I think the main server was in Tower 1 and the backup server was in Tower 2. So obviously both towers were lost. So that database for that company was completely lost. So I've talked about baseline protocol a bit. And so it allows you to do transactions on mainnet and use it really just as an ordering service. So you do private transactions off chain. So you've got all your data in your own database and you're using it as a way of coordinating state updates between different parties. So there are hundreds of companies that are involved in this at the moment and dozens of use cases. So I encourage you to look up baseline protocol. So I haven't talked about self-sovereign ID. I haven't talked about legal contracts on blockchain. I haven't talked about making sure you've got authenticity over who's doing what, from releasing information and doing securely sharing documents. And there are many, many other use cases that I just haven't touched. So don't think this is the be all and end all of it all. So the Worst and Gervais came up with a decision tree, and I've modified it a bit because I don't like the decision tree. And I think this is closer to what we've got here in 2020. So if you're handed a blockchain project, or if you're evaluating a project and thinking, does it make sense to use a blockchain? Think about this diagram here. So is there state that needs to be stored? Yes or no? And are there multiple writers? So is there going to be more than one party writing to the system? And so if the answer to both of those are yes, then you're going to probably, some sort of blockchain is going to be applicable, and otherwise not. And so if you know all of the people who are going to write to the chain, then it's a matter of whether you need to verify publicly what's being written. So you remember how I talked about the use case where you've got supply chain and you want to show provenance and you want the supply chain people to write to the chain, but you want the general public to read. So in that case, you get public permissioned. If it's a closed chain and it's only between participants in the chain, then it's going to be private permissioned. And if everyone can read and write, but you don't know who's going to write, then it's a permissionless chain. So blockchain technologies are changing fast. I think DeFi is going to be around for a while, but there will be other use cases that will come to the fore. I borrowed diagrams from all over the place, and thank you to all the people that I have borrowed the diagrams and pictures from. In 2 weeks' time, we're going to have a talk from Jacob and the MetaMask team about how to use MetaMask in applications. It's going to be at 9 a.m., not 12:30. Then at 10:30 a.m. in 4 weeks' time, we're going to have an introduction to quorum, consensus quorum. And then at the moment, in 6 weeks' time, I'm negotiating for us to have someone from the Filecoin team tell us about Filecoin. So that is all. So thank you very much, everyone who's hung around to the end. It's 1.5 hours, which is pretty good. And at this point, I will ask, are there any questions?
Peter, it's Nigel again. I've got a quick question if you've got a minute. I'm struggling to, and maybe this is one of the problems with blockchain technology, I'm struggling to understand how it connects with the real world, with some of the applications you've described. So say, for example, the shared ownership of real estate. you know, you've got 100 investors and maybe you've got 100 tokens or whatever. But what connects those tokens to what's in the physical world today, such as, you know, the deeds of the property, and what gives those token holders the legal right to have a claim over that real estate? Do you know what I'm trying to say? Like
Yeah, that makes sense. I think that you will find that when you it's going to have to be some sort of thing written that says that this, you know, some legal document which says the ownership of this, you know, apartment building is held by, you know, with this ERC20 token or something along those lines. I think that's how it's got to be.
Yeah, okay, that's what I thought myself. I just wanted to make sure that there wasn't some U-Butte solution that connects the digital world to the real world, or if there is, I'm not aware of it. It doesn't sound like there is. Oh, that's good. Thank you, and thank you for your time today. I really enjoyed that. Well done.
Yeah, no problem. Sly, what did I miss? Sly, you on mute somehow?
Yeah, I think I'm unmuted now. That work?
Yeah, it's good.
No.
No, I can hear you.
Ah,
All good.
yeah, no, it was good. Mostly I look at Ethereum 2 stuff, so, but it was good talk. Yes. Some of it's a bit hard to get your head around with the how does the algorithm for difficulty work and all that, but it's some very smart algorithms in the protocols.
Hey, Sly, this is kind of a random question, but so the transition between Ethereum 1 to Ethereum 2, do the dApps that are created on either platform kind of just automatically convert to Ethereum 2 and proof of stake?
I'm not sure if you saw Peter's diagram that he had up.
I can pull it up now.
Yeah, the plan around the Ethereum 2 is that the execution engine for a dApp is going to be one shard in Ethereum 2. So you'll still have a dApp running and executing the same logic of whatever's written in that dApp. It's just that when it comes to approve that block or integrate that transaction into the block, the mechanism behind it, instead of being an Ethereum 1 proof of work stamp that everyone accepts, it'll be an Ethereum 2 beacon chain that everyone accepts.
Gotcha. Thank you very much. And then last question, just a conjunction with that. What's the benefit of going to a proof of stake rather than a proof of work and like try to keep everything the same?
That's more of an economics type question. One thing people complain about Bitcoin and Ethereum 1 and proof of work is it uses up all the electricity. That's not actually true from an economics point of view. What actually happens is people are willing to pay $10 in transaction fees, which means that I'm willing to spend $9.99, or probably a bit less because I want to make a decent amount of profit, $9.90 in resources in order to win that $10 fee. At the moment, the main resource used to solve proof of work is electricity, which means that from an economics point of view, you have to buy that one resource. With proof of stake, the resource that you're using up is a bit more abstract. It's invested capital, and because it's invested capital, it means that what I'm giving up by doing that is not investing my capital somewhere else, which means that I'm not going to invest take my capital away from the least productive thing anywhere in economics and society and put that into funding fee, into providing proof of stake. So from an economics point of view, it means that the cost of those transactions is economically a lot lower because it's the least useful thing rather than electricity. So that's like the economics answer. It should mean less electricity is used, basically.
Or another way to think of it is, wouldn't it be great to use all that energy and all those computers to actually do something rather than just searching for a cryptographic puzzle? Yeah.
Yeah, the economic cost is going to be the same. You're going to spend $9.90, except instead of spending electricity, you're spending unused capital, which will be a lot more.
So is
more
proof of
useless
stake
thing.
essentially going to be faster because not everybody's working on these cryptographic problems all the time with their computer power?
Won't be faster because the time is set by the algorithm. So the reason Bitcoin takes 10 minutes is because everyone agreed we want to set the protocol to be 10 minutes.
Yeah. Well, it's also latency across the planet. I think with Bitcoin, they were super conservative about the latency, and that's why it's 10 minutes. Whereas in Ethereum, initially it was 15, and then I think it was 12 seconds at one point, and then they did calculations on the forwarding of the information around the planet. And if you get too low, then information hasn't got enough time to be sent around the planet and verified, from all the different miners, and hence you potentially have forks in the blockchain. So it's generally better to have.
Yeah, so the sharding will help with that performance and things like that, because you have to get the information to only a subset of people. So it's not proof of stake itself that is going to help with that, it's the sharding.
And Sly, is the same true for the gas fees, which are now astronomical? Would the sharding help that as well?
Gas fees are purely economics. It's whatever people are willing to pay, versus what people are willing to provide. So, what the current high fee is effectively saying is that people really, really want to use this. So that's not necessarily going to. That's not a technical issue. That's an economic issue.
It's a different. Yep. Cool.
And I think the other thing as well, I mean, some of us have we've been looking at, for Ethereum 2, will the gas fee be the same on all shards? Open question. Will the gas fee be the same on all containers? So the EVM, Ethereum Virtual Machine, which is where all these ERC20 tokens are currently processed, you might have more than one container per shard. So there's a lot of open questions, and if you're a researcher or you just want to throw your 20 cents in, you can try and contribute to the standards and say, what you think the best idea is and why, and push your case.
Thank you.
I'm cognizant of the fact we've been on this call for, some of us almost 2 hours, but certainly 1 hour 40 since I started. Are there any questions? All right, we're all good. Okay, well, I hope to see you all in 2 weeks' time, if not before. Bye-bye.
Thanks, Peter.
Thank you. Bye-bye.
That was great. Thank you.